We have Mr. Arvind Singhal, who is the chairman and the MD at Technopack Advisors, joining us to try and gauge what's the sentiment on ground there. Very good morning to you, sir. Thank you so much for joining us on ET Now. And let's start up with the private consumption, which is expected to grow at a CAGR of about 10.4% from FY24 to 29. Which specific factors do you think is driving actually the surge, and do you also foresee any sort of risk that could actually go ahead and derail this sort of a trend that we're expecting?
Good morning. So I think it's no mystery in terms of when you're looking at a 10.4 or 10.5% projected growth rate for private consumption. If you look into a real GDP growth rate of about 6.5%, and look into inflation at about 4.5%, nominal growth rates would be closer to about 11%. And I think that trend will continue for a very long time. I don't see GDP growing below 6.5% on a long-term basis. Having said so, I think the important thing is like this, that as far as consumers are concerned, their basket of spending on goods and services has been very steadily expanding over the last 30 years. Just to give you a sense, my company started working in 1992. At that time, 80%, 80, of total private spending was accounted for by 8 or 9 categories of goods and services. Today, it is closer to 25 there. So to that extent, I think if you were to look into overall private spending, I think the prospects look very good. I mean, assuming that 10 to 11% is seen as a very good prospect. Yes, there will be some segments which might show slightly better growth. For example, educational services, leisure and recreation, travel, and healthcare. These are outpacing this, let's say, the baseline of about 11%.
Okay, so education, healthcare, the higher end of consumption in terms of travel, tourism, all of that is seeing quite a bit of traction. Mr. Singhal, hi, Anisha joining the conversation. I understand that the long-term prospect is of a double-digit growth, but what do you make of the immediate term? And I'm talking about the kind of, slowdown that we have seen in consumption in Q2, and Q3 hasn't really panned out that well. What's been your understanding of what's causing this slowdown, and how much more to go for this leg of the slowdown in consumption?
So I personally, and I'm not necessarily repeating what the finance minister said a couple of days ago, I think one quarter should not necessarily be seen as all doom and gloom kind of a story. We know very clearly that Q2 had very peculiar weather patterns, excessive rainfall followed by significant amount of poor, rainfall conditions, and all of that may have had some impact on consumption at large. I personally feel that with especially agriculture likely to do better and the money coming into the hands of the rural India in Q3, whatever we may have lost in terms of the possible opportunity of consumption in Q2 will probably bounce back in Q3 and Q4. So I would not necessarily want to analyze far more than what has been done already about what happened in Q2, because there could be some external factors.
The slowdown in the basic consumer discretionary category, soap, shampoos, toothpaste, more like a 6-7 quarter phenomenon, because every quarter we think that things would improve. Sometimes we blame it on summer, sometimes we blame it on winter, sometimes we blame it on rain. The reality is that at a time when nominal GDP is growing at 12%, a wealth creation is getting created in India, stock market are booming, real estate is booming, gold is moving, FMCG sales are not there.
So Nikunj, delighted to interact with you again. See, I think I think we have to, the multiple moving parts to this story, not a single moving part, if I may say so. In no particular order, I think firstly, if you see the very long tail of new players which have entered the BPC, the beauty personal care segment specifically, and if we aggregate them, you will find that the growth is not as bad as it may have looked out from the few historical bellwethers. I do not call them bellwethers anymore. I don't want to name them, on the show at the moment. So that is one possible explanation as to that the sector is not necessarily doing so badly. Some companies may be struggling, number one. Number two, look into the impact of private label across categories. Yesterday, Vishal Megamart went for a bumper listing. Their revenues are about 8,500 odd crores. 65% of their revenues come from private label. Okay, I'm not saying that they are in the beauty, personal care, or FMCG category at large. Reliance Retail at about 3 lakh crores probably will have about 50% also share of private label. And then when you look into Nykas of this world, you look into so many other categories there, so many of the retailers there. And now increasingly the likes of the Zeptos and the Blinkits and Instamarts there. Net, what I'm saying is that even private label is probably also taking some of the share away from the branded players. So maybe the story is not as dim as it may have made out for, especially in fact, I'll flip this argument around. If it is 6, 7 quarters where some companies are struggling, I think they need to look more inward internally as to what they might be doing differently rather than only blaming the external factors of economy.
Okay. I'll talk about a theme which in a sense is a popular theme, quick commerce. Really, I mean, it has just become such a success story. But in your understanding, do you think quick commerce is something which would be a metro phenomenon, maybe 20 cities, and then it will run into rough weather? Because Indians are, I mean, we all know that Indians will always prefer price over time. In metros, it is convenience, but in semi-metros and urban cities, who's going to pay 40-50 delivery rupees to order 2 kgs of tomatoes and 1 kg of potatoes?
So I would like to split this question into 2 parts. One is the time part, which is the quick part. And for the longest time, and longest does not mean 5 years, quick commerce is a very new phenomena. At least in the last 12 months, I've been saying we should be using the word quicker commerce there rather than quick commerce. What it means is like this, that yes, the Zepto did put a pressure on the other incumbents to start delivering in minutes as opposed to in hours or days. But as we read today, the Amazons of this world, Flipkarts of this world, Reliances of this world, Tatas of this world are all actually shaving off those days into hours and hours into minutes. So practically entire e-commerce will be now quicker e-commerce as opposed to the distinction between quick versus traditional commerce. That is a one split I would like to just mention. Therefore, your question has to be seen, what is the likely penetration of e-commerce beyond the top 20 cities? And my answer still remains to be a bit more conservative than many other players. There are multiple factors, which will limit the proportion or the share of e-commerce of the total merchandise purchases of India. You rightly talked about the tomatoes and potatoes and the perishables. More than 50% of India's merchandise spending, even today, is food and grocery. And it is spread across 500, 600,000 villages, 5,500 towns, barring the top 20 cities. And even in the top 20 cities, barring a very limited strata of society, the traditional commerce, whether it is organized modern retail or whether it is Kirana equivalent of small retail, is vibrant, is doing well, and it'll have a very large share of the market. So quick commerce is a smaller niche of a larger niche, I would call e-commerce.
No, fair point taken, Mr. Singhal. But then what happens to the incumbents, the likes of DMart is the question, because they haven't upped their game for quick commerce as yet. Do you think there is still a addressable market for them that continues to be strong, or do you think they will have to pivot one way or the other?
In my personal view, the challenge with DMart is not so much from e-commerce. My view is that DMart has been very complacent in terms of sticking to one format. And that one format of a big box, large store does not necessarily travel very well beyond the top few cities in India. Real estate is always a big challenge. I think by this time they should be considering, they haven't considered so far, creating new formats. I mean, Reliance is one example. You have to grow the business by also looking at more formats. One size fits all is their bigger challenge, according to me, not so much as e-commerce.
Arvind Singhal, the investor, not the consultant, not the chairman of KSO Technopack, has to make an investment in a retail company. First tell me a theme for 3 years and then you tell me a company.
Well, I'm very poor in liquid, so I can't think more, because if I make a statement, it might be taken a bit seriously by some of your viewers, and they might end up losing
We
money.
always take you
So I will
seriously,
refer-
and I know you're a good investor, and you've been tracking retail for 35 years. I don't want to use the word, you are the grandpa of retail. I would use the word OG of retail, because that's the more fashionable word now.
But on a serious note, I'm far more bullish if I have to put money into manufacturers of consumer goods compared to the channel. The channel is actually getting very, very crowded already. I'm talking about the organized retail channel, whether it is digital or physical there. But consumer spending is likely to remain very robust. Consumers are going to buy better products there. And therefore, I would rather be excited about companies which are in, especially packaged food companies, for instance, food processing companies, equipment makers for, let's say, quick service restaurants companies. Those to me are far more exciting stories than the last mile channel.
All right, then we leave it there. Mr. Singhal, thank you so much for joining us in ET Now.